Hello traders, welcome to the LFB and our global video charting review. This is for Monday, March the 7th, 2011. Hope I find you well. We do have to point out that Forex trading does involve substantial risk of loss and is not suitable for everybody. Each investor should assess their individual situation before proceeding. We also post disclaimers to the LFB website, which we would ask you to read and accept before taking any detail and data from the video. Looking at the S&P 500, global traded markets work their way back towards this week's opening prices in trade on Monday, which is where equity and currency markets sat ahead of last Friday's non-farm payroll employment report, which was widely anticipated from the US. Asian equity markets had absorbed selling pressure on the first session of the week and managed to hold support as European and US equity trade found buyers in the pre-market. As we can see on the move on S&P in the pre-market, we did move higher. Equity cash trade, however, reversed the bullish futures tone and sent S&P 500 back towards this 1315 area as the Monday session unwound in a very disjointed period of cash trade that looked to be desperately searching for sustainable momentum and sentiment reads earlier in the session just couldn't hang on to the upwards movement. We do have the 20-day simple moving average sitting here around the 1320 price point, and we may oscillate around that area as this week unfolds on S&P trade. Precious metals saw gold bullion futures break 1440 on Monday. That was in line with silver markets. We look at the gold market, we can see move higher, a little bit more disjointed than you'll see on these silver markets. These silver markets do look to have a much more bullish tone to them. The sentiment and momentum indicator alert that was sent out to clients to get long on silver with a break of 34.60, that's now completed its upside targets, and traders will now be looking for consolidation and a new signal to form. Now would probably not be the right time to be looking to get long gold or silver bullion at these extended levels, as a pullback to support is going to be required so that the potential strength of the next leg higher can be more easily gauged. Looking at West Texas Intermediate, which is the most liquid of global traded crude oil markets, looks very similar to the silver chart that we just looked at. West Texas WTI moved higher to test 107.15 in overnight trade, which completed the sentiment and momentum indicator alert that was sent out to clients on Friday, which was looking for a long break of 102.50. That's now hit both of the upside target areas. The speculative nature of recent oil market trade, which has hedged the potential disturbance to crude production, has formed a solid long trend that's going to be very difficult to easily reverse back below $100 a barrel on WTI. A move to test the strength of support, however, around 102.50 does seem to be likely in the next period of trade before oil markets could then easily make a sustainable break up towards 110 a barrel. Interest rate markets have gone through a very sporadic period of trade, which has seen the 10-year Treasury note value drop to test 119 support. The converse reaction to that move has been for interest rates to climb higher, which will be against the desires of the Federal Reserve to maintain a low interest rate environment in which to manipulate US dollar values. Equity and interest rate market correlations are testing their historical norms, which is in line with global market correlations that have spent the last 3 months resetting themselves and trying to find fair value. Taking a look at the major pairs, looking at euro dollar, which is an inverted dollar index chart. Euro dollar makes up 60% of the dollar index. As the euro dollar pair went up to test 40.50 as a resistance area, the dollar index was finding support at 76 on trade on Monday, after having absorbed on the dollar index some long-sided moves in the global commodity and precious metal markets, which historically should have created stronger negative impacts on the dollar index trade than has been seen recently. Although the dollar index is in a short trend and has been weak in its intraday trading patterns, the strength of the precious metal market and commodity markets has not transposed itself into a compounded weakness on the dollar. The dollar's held up relatively well in relation to the moves in other markets. The last 3 months of trade have seen dollar-based asset classes testing the resolve of these historical inverse intermarket correlations. The move towards the long side of euro dollar and the move towards the dollar index in the near term trade on Monday, where we can see euro dollar dropping lower as the Wall Street session closes and European markets wrap up for the day. We're seeing a move higher on the dollar index, but that doesn't seem to be motivated by a desire to be long the US economic outlook, but more likely to be in reaction to those central bankers that control exporting economies who will now be looking for regional currencies to lose some of the recent gains that they've made, which will impede the ability to maintain growth and expansion for those markets exporting at much higher rates because of the weakness seen in the dollar. In general, it would seem that a period of consolidation is going to be taking place in equity trade, with equity buyers having their attention drawn to the bullion markets, and it would seem that bullion markets are now going to be reacting to the interest rates that are unfolding, with speculation that some central banks will be looking to raise rates. But that does seem, though, that in the near term, we are going to see a test of upside resistance on the dollar index towards 77, which would be a retest on euro of the breakout area at 3,900. So we will be looking for euro to get down and test 3,900, and conversely for the dollar index to make its way up towards 77 resistance from the current 76.20 period during the course of this week's trade. It's going to be very, very interesting. We're still holding the mantra of bank early and bank often, because these markets are showing very sporadic price action periods of trade.